Hey
Well,
everybody. Hey everybody, Preston Brent here with our trader user group. This is for the trading week ending June 29th, 2018, the last day of the month, last day of the quarter. Wow. All I can say is wow. Halfway through the year, and you guys remember that old TV show Lost in Space where every weekly show, they always things would go smooth, and then there would be some monster or some kind of cataclysmic event that they were going to all perish. And at the very end, the robot or real Will Robinson or someone else saved the day, and then they would be safe again for the next week's episode. And then next week it'd start all over again. That's kind of how I characterize these markets, lost in space. I mean, this past week we saw the Dow down about 1.2%. A little over 1.2. It was down the prior week also. The S&P finished down about 1.3%. It was also down the prior week. Nasdaq was down this week 2.37%. It was down the prior week as well. But the only thing that was up this week was the volatility, the VIX. It finished up for about 16.8 or no, it finished up about 16.09, and which is about a 16.8% increase from the prior week. We're seeing trade tensions continue to brew, which could cause trouble from China to Europe, Canada to the south of us, Mexico. And we also saw, according to a big trade desk, about the last 15 minutes of the day, I was posting in our chat room and I told our folks, be ready for some more downside action as we go into end of quarter, end of month, end of quarter, because there's going to be some profit taking as we go into a more uncertain Q3. There was a large order I saw in Bloomberg that came across the desk, 3.4 billion sell order that came in the last 10, 15 minutes of the market. And I suspect they didn't want to do this sell order during the beginning of the day. No, normally these kind of end of quarter big orders come in at the very end, all right, where you just couldn't react to it and boom, they dropped a hammer on it. So that came across. Also, as I mentioned the prior week, we're seeing the 90-day T-bill providing almost the same yield as the dividends in the S&P. So money's leaving the equity markets, those that like income, and going into the 90-day on the shorter duration 90-day T-bill, and just collecting interest there. And I saw a report out of Barron's where U.S. equity suffered its second largest outflow to the tune of 29.7 billion this past week from equities. And earlier in the year, remember January? It's kind of a distant memory, but when the markets were just exploding higher, we saw about 103 billion go into equities. But over the last 5 months, since January, slowly about 50 billion of that has come back out of equities. And in spite of all of that, we've got the Chinese, or in addition to all that, rather, we see the Chinese markets, they're in official bear market territory. I'll show you the chart here in a minute. Emerging markets are still getting crushed by higher U.S. rates, U.S. dollar. We've seen the Chinese yuan depreciate just over the past couple of weeks, over 3.5%. You guys remember August 2015, where China came out over the weekend and just artificially dropped their yuan over 2.5% in one day. And the markets had a huge, huge reaction to that with the VIX going up. At that time, the largest spike in VIX ever. It went from like in the low 12s to over 52 in about a 4 or 5 day period. Okay. But we've seen China slowly change how they evaluate or put a valuation on the yuan, moving their reference rate just a little bit. I've explained with our members what that means and how they do it, but they've reduced it so that the yuan is down about 3.5%. Now, one of the things that they've done is they went the People's Bank of China, which is, I don't know why they call it the People's Bank, because the people there have nothing to do with it. It's all government run. But they injected, the net effect was they injected about 100 billion into their banking system when they loosened all their reserve ratio requirements for banks across China. So that's one way China can fight some of these tariffs, is by reducing the yuan. But they can't go too far, because if they do, money's going to leave China and flow back out again, and it's going to cause even more problems for them. But needless to say, they are in a bear market right now. Okay. And we've got these trade wars that are continuing to punish the markets. When they first came out and first surfaced about 4 months ago, if you guys remember, every day the Dow was up 300 points, down 300 points, up 500 points, down 600 points based on a Trump tweet or one of those kind of things that just kind of hit the news wires, right? I mean, it's up and down. And then finally the markets gave up and said, screw it. We're going to wait until something actually happens because we now think this is the way Trump negotiates. He'll throw some really crazy, ridiculous thing out there and we're just going to ignore it until we get an idea of what actually is going on. Well, over the past 2 weeks, slowly the markets have come down. We've seen the S&P down about 2.2% over the past couple of weeks. Remember, I said they've been down 2 weeks in a row. Most markets have, suggesting to me that the markets are starting to pay attention again to the potential impact of trade tariffs. Now, I've been telling our members, and we've been buttoning down the hatches and going a little bit more to cash and adding to our hedges over the past 3 weeks, because I've been telling our members that July the 6th is going to be a drop dead number or a drop dead date regarding trade tariffs. Why? Because that is the date that Trump has come out about a month or so ago and said July the 6th is when this first set of 50 billion in tariffs is going to hit China. And it's on a Friday. And that means on the weekend, China would come out and obviously retaliate. And you know, I don't know about you guys, but it seems like all the bad news out of China always comes on the weekend. So that Sunday night when the futures market opens up, the markets they're already down huge numbers because China's retaliated on a Saturday or a Sunday morning. This time we need to be ready. Now, if Trump delays that tariff, and you'll see if it's a negotiating ploy, because I've been telling our members now for weeks, he'll say something like this, or the Trump administration you'll see words come across the transom that says something like this. We're making progress with China, blah, blah, blah. We seem to be going in the right direction. They seem to be more willing to work with us on import duties and taxes and blah, blah, blah. So we're going to extend our deadline from July the 6th. We're going to push it off another 90 days in hopes that in a good faith effort that we can make these negotiations work. So when Trump says that you're going to see the markets explode higher. Okay. Right now, the markets have sold off, a couple of percentage points over the past 2 weeks of the coming July the 6th date. So pay attention to that, guys. It is going to be a key number. The other thing about July 6th is we've got a key number on jobs reports for June. And that is going to be key for the Feds because right now, one of the things that all analysts are talking about, I don't tend to follow them too much, but I just like to know what they're thinking, is that the markets right now believe the Feds are only going to hike the rates one time this year, one more time. That'll be for 3 for the year. The Feds have been indicating 2 times. Now, if the job numbers comes in strong and it shows wage growth more than 2.9% year over year, which is what it was last month, then you're going to see the market sell off because that means, yeah, maybe they could do 4 rate hikes this year. And the markets will react to that. And that'll further drive down the yield curve, which, by the way, is around 31, 32 basis points. Okay. And this Sunday for our members, I'm going to go through a little bit more detail on the yield curve, but we've been talking about it now for about 4 months. And the yield curve is a good canary in the coal mine as far as what the markets may do anywhere from 4 months out to a year out in time. So we got to just pay a lot of attention to that. So we've got a lot of things coming up here. And like Lost in Space, towards the end of the episode, when everything looks like it's just going to blow up and there's not going to be any more series because all the members and cast crew have been killed off in the series you're watching, all of a sudden some good news comes. So now we've got earnings coming up in another week. So this is the good news, bad news that you always see, or bad news first, then good news that you always saw in Lost in Space, right? And it gets you to the edge of the TV rooting and hollering for whatever is going to happen with that robot running around going, danger, Will Robinson, danger. It's pretty funny. So here, though, it's real money in the real market. So what is the potential good news? Well, earnings are forecast to come in Q2 very strong. Not as strong as Q1, but strong enough to keep the markets propped up to possibly move higher should the trade tariff issue be removed from the markets. Right now, the trade tariff issue is putting a big pressure cooker lid on the markets, keeping it from going higher, right? It is amazing what it's doing. It's putting a big pressure cooker on it. Q2 right now is forecast to come in at 19.5% growth, year over year growth. Q1 came in at over 23%. And over the past 30 days, analysts have increased that 19.5. It used to be 19. They moved it up 50 basis points. On average, 30 days before earnings start, the average is a reduction of 150 basis points. That's 1.5%. So this increase is a good sign, not a bad sign. And in Q3, the forecast is 22.3% growth, in Q4, 18.4% for a full year on year earnings per share growth of 20.6%. All in all, a great year. These earnings, these tax cuts and repatriation of money is really going to start taking full effect as we move through the summer into Q3 and Q4. But all of this can be subdued greatly by these trade tariff issues. Now, I thought Trump was a little bit more political savvy than this. And I mean, I'm surprised he picked now going into the midterm elections to do this. I figured he would wait till after the midterm elections and then start doing these trade tariff issues, because that is clearly going to hurt the markets. And Trump wants the markets to be higher. All right. Every time the markets sell off, he tries to do something to prevent it. All right. So this is what I'm looking at right now. It is a lost in space kind of series that we're looking at right now. These big events coming up this next week, July the 6th, the trade tariffs, the jobs numbers, which means, are we going to do just one more rate hike or four more this year, or is it just neutral? So we got those big issues coming up. And then, of course, we got the feds and all the other things from that. One other thing this week, which is going to make it interesting, is that we got a holiday here for all of our U.S. folks that attend this. We've got a very strong international audience. A lot of people in the Asia Pacific area check in with us, or our members. Same thing with Latin American markets, European markets, South African markets. We get a number of members internationally. Even in Europe and Eastern Europe, we got members, which is cool. So next week is going to be a holiday week for the U.S., so things are going to be really slow. Just as a reminder, the markets are going to close Tuesday, July the 3rd, here in the U.S. at 1 o'clock New York City time. All right, that's 1 p.m. Eastern Standard Time, 1 o'clock New York City time. And then they'll be closed all day on Wednesday, the 4th. And then we get a final rush the 5th and the 6th. So it's going to be a holiday shortened week. We're going to see traders start to pack it up and go home Tuesday morning. And then a lot of traders are going to be off Thursday and Friday. So it's going to be a very low volume week for U.S. markets. And U.S. markets right now have been driving the ship because it's the only pig in the pen with lipstick. All the other countries, China, Asian markets, emerging markets, are underwater big time. I'll show you the charts here. So speaking of the charts, why don't we just jump in and let me just go through it real quickly and show you where we're sitting. What I've got on the screen right here is the S&P 500 E-mini futures. And as you can see on this chart, like I said last week, guys, this key pivot point here, we could not take out, and I said the odds favor a pullback to our S1 zone right there. And that is exactly where we've gone, and we're sitting right in the middle of it. You can see we're right below the 200 or the 50 EMA, the 200 EMAs in really an S2 support zone down in this area here, which we can get there very easy. If these trade tariffs go through, and Trump makes good on his promise on July the 6th, the markets are going to come down, I believe, and test these 2018 lows right down here, which were made in that big February sell-off. Okay, and it can get down there very quick. All right, if I draw a line from where we are right now, there is that bar right there, and we literally made it in. And this is a daily chart, guys. We made it in 2 days. All right, from where we are right here down to here, we did it in just 2 days. 27.20 down to 25.29. Now you can see a lot of buyers stepped in and start buying here, but that's a different kind of environment than we're in right now, because these trade tariffs, if it comes down to this level here, the big fear for big money, even with strong earnings, companies are going to suffer, especially large cap and mid cap. Smaller cap will be less impacted. The big fear will be this has a greater chance of escalation than deceleration, which means we could blow through these. We could have maybe a dead cat bounce, run up to like an area like that, and then come back over and have a further capitulation. And off of the highs, That is 12.16%. So we could come down to like, 15 to 18%. I don't think we'll go into a bear market because we got very strong growth corporate wise, but it'll come like this, and then you'll see the Trump administration and others starting to take some steps. Right now, the markets are assuming this will not happen. The market still, even though we pull back over the past 2 weeks, because we were up at almost the 2,800 level, not quite, but close. We pulled back to the 2720, about 80 points, E-mini handles in the past few weeks, guys, because the markets are just now starting to get a little bit nervous about these trade tariffs. And it's like lost in space. You don't know what the next series is going to bring. And it's very difficult to trade more than, say, a 3 or 4 day trade, because when you're trying to take a position trade in this market, it's very difficult because we've been all over the place. And if we look at the better performers out there, Nasdaq took a beating Monday of this week. Look at that big candle. This is a daily candle here, and you can see here from the highs at 73.58, we're just barely above our 50 EMA right now, that red line. And you can see we moved below it on Wednesday of the week, and we closed above it on Thursday, and then we finished here on Friday. And one thing I wanted to show you guys, which is a bearish candle, even though we finished up for the day. Let me just blow up this candle here so you can see it a little bit better, right? So blowing up this candle here, I mean, look at this. I mean, these are called hair on the candle, right? Hair of the candle, I guess. Look at these big wicks up on the north of these candles, right? That means any move up here has been a chance for sellers to really push it back down again. And this on Friday, if you guys remember, we were up a pretty good bit. We were up over 27.45, 27.46, and we came down to 27.20. We finished up just barely, but that's a bearish candle, folks. That shows in that big move down like that, any attempt at trying to come up is going to be shoved right back down again. So ending the quarter, Q2 on the way that we ended it is not good. Now, I believe the markets are going to take a little bit of a stand down here and see what happens. We're seeing some hedges come back into the market, as I said earlier, where you had that 3.4 billion sell order come in the last part of the day. I was telling our members around noontime, I said, as we go in the afternoon hours, be very careful, because we could get a sell-off, just some profit taking as we round out the quarter, and then money flowing back a little bit more into the 90-day T-bills. All right, you can see here there is no divergences on the MACD, so that still tells me that any lower move is more than likely going to be bought, but all of that is going to be for naught if July the 6th comes and those tariffs actually hit. And if we look at the Russell, I showed you NASDAQ. If we look at the Russell and look at their performance for the week, where did it go? Here we go, right here. If we look at the Russell, you can see here we're just holding above the 50 EMA, all right? We've got a flat MACD, so that suggests we can come down to this trend line right here. If I kind of step it out a little bit, you can see this trend line that we hit from early February. A little bit of a pullback here to that 1619 area. That's from the highs, all-time highs of 1720.80. So a little bit more downside would not be surprising to me at all. This was my estimated back in March upside resistance level, and that's kind of where we went and hit, right up in that area, and now we're pulling back a little bit. So that's a little bit about where we're sitting on the rut. And if we come over and let's look at the Dow, which is like the one that's just been hit the hardest. I mean, just been crushed. If we look at the Dow, we're in the red for the year. And here's the 2018 open price. There's the 50 EMA. There's the 200 EMA. Now, this is the EMA, not the SMA, the simple moving average. The Dow is below the 200. But on the EMA, we're above the 200. We're sandwiched right in the middle of the two. Okay, so this suggests we've got a lot of chop. Folks, as a warning signal that I give to my members, when we move below the 50 EMA, the yellow caution flag automatically goes up, and it suggests more chop. Doesn't mean the market's going to go into a bear market. Doesn't mean the market's going to go up. It just means more chop. And that's what we're getting right now with the Dow. And this down move here, this downstroke suggests that from this low right here, this is solid selling right here. All of this is related to the tariffs, every single bit of it. Should those tariffs go through, guys? Should they go through, we're going to come down and we're going to take out that 2018 low, right? We're going to take that low out. Boom, we're gone. We're history. See ya. We'll kind of come down to this Fibonacci node right here around 22,300, roughly 22,300. And I think it'll be relatively quick. All right, you can see over here, as I said, same thing in the E-minis. It only took a couple of days and we were there. So just don't kid yourself, right? And so that's why I'm putting some of this on. Now let's look at transports. Transports is also kind of an early warning signal, anywhere from 60 to 120 days out for the Dow. Look at the transports. We're sitting even lower on the transports than we are on even lower than we are on the Dow. Look at this. We're just right. We actually closed below the 200 EMA and then we moved right back up, but we're well off and we're in the red for the year. You can see the transports have rolled back over again. So again, early warning signal for us, guys. Everything is setting themselves up for more downside action unless these tariffs go away. The markets fundamentally are sound, so that'll provide any down drop will not be as severe. But the markets right now have a hard time pricing in uncertainty, which is what we got, which is why I call it kind of a lost in space kind of market right now. The markets have no trouble pricing in risk. Is it going to be 2 Fed rate hikes? Is it going to be 3? We'll use the 30-day Fed fund futures to predict 2 or 3 rate hikes and, the dot plot and so forth. Pricing in risk is what the markets do on a daily basis. And they forward price it in and it gives you the current price today based on risk of 6 months from now. But uncertainty is a different story. Markets have a hard time, if not impossible time, pricing in uncertainty. So what do the markets do? In uncertain times like that, they sell off. They take the higher road and just say, well, we're just going to sell off because we don't know what's going to happen, but better to sell off and reduce our expectations. And then if it's postponed, then all the better. We're going to just jam right back up again. But until that happens, this is what we're seeing right now. Okay. Let's look at China. China is in a bear market. Look at this. They're down 25.97% from the highs in 2018 to the 2018 lows. You can see the 2018 open price. We're down at the bottom now. We gapped up just a little bit on Friday, but is it a dead cat bounce? Who knows? The other thing with China, they're getting hurt more with the tariff talk than we are, obviously, because they've got the larger number to lose, as Trump suggests. But we've got the 50 cross in the 200 EMA. That's called a death cross, right? And that death cross suggests what I've seen when we get these kind of things, it acts as a really strong resistance point where markets sometimes kind of find their way back up there and then boom, they come right back down again. But either way, that is a overall downward kind of event for the markets. Now this is China, so you can see here that will China drag the rest of the markets down, or will the U.S. hold the rest of the markets up? It's a lost in space moment. Who the hell knows? But I think a lot of it's going to be driven by the tariffs and what Trump does and his Trump tweets. I've said this year, since the beginning of the year, if you guys have been watching my blog here and my postings, our members, because I talk about it every Sunday night, it's the 5T market, tightening, tariffs, those are the two main ones right there. Technology, because technology is overextended to the upside. If technology sells off, the rest of the markets go because they're kind of holding the markets up a good bit. And then the final two T's, well, I just call them the lost in space Trump tweets. Who knows what's going to come out? And it's just made the markets extremely volatile. The markets are used to a president that does a lot of this negotiating and sausage making behind the scenes. It'd be like if you ordered a hot dog, but while you're sitting there after you ordered a hot dog, you see them slaughter the pig, you see them mix all the spare parts of the pig, the bone, and all this other crap, and scraping off the floor and throwing it in a blender and putting it in, and then bringing the dog out to you, and you're looking at it, and they go, "You want mustard with that?" By then, you've kind of lost your appetite. So I prefer negotiation behind the scenes and get some of this off the table, so that the markets aren't just wild ass woolly right now, or as I say, lost in space. But that's kind of what we're looking at right now on all of these. All right, so this is the tracking stock for China. And let's look at the Vanguard All World Index. It's not only China, guys. The All World Index is, look at the 2018. I didn't mark the distance from the open up here. I mean, this was the high back in January, and you can see we're down, hugging the bottom. There are no divergences here. That suggests any move up is going to roll over. And then it gets worse from here, because if I put in the emerging markets, you can see the emerging markets. I didn't even have a chance to adjust this on Friday, but let's just come in and move it down like that, right? And you can see that, the emerging markets right now, they closed at 43.33, right? So if I were to put the lows down, the lows down here, which would be right at 42.15. So let's just look at this and just put in 42.15 and just see kind of where they move to, right? So if I put 42.15, not quite in bear market territory yet, right? Now, obviously, we've moved up a little bit, just like with the China Asher, the tracking stock for China. But no matter how you put it, um, it's still not good. And the emerging markets really low. So now you could do the contrarian play for Q3, where you could go long emerging markets, long XLP, because I'll show you something here. If we look at XLP, it's a risk off sector. And look at what XLP has been doing since the beginning of May. There's no doubt in my mind which way XLP has been moving, right? You can see XLP has moved up like that. XLP has moved up really nicely to the rest of the markets since early May. That is a risk-off sector. So some of that money has been going into the risk-off sector. Again, an early warning signal that you got to lighten up, and you got to maybe go into some of these sectors that have been crushed lately. How about utilities? That's another one. Let's see what they've done. We look at utilities. Look at this one. Again, a risk-off sector, a big risk-off sector. And utilities, right around the beginning of June, right? Boom, it's moved up big time in the month of June. So we're seeing some of these risk-off sectors really see money flow back into them again. So this is something that you guys need to take heed of. And all of this is related not to the corporate earnings, because they're just outstanding this year. This is more related to the tariffs and the possibility that inflation, which has been non-existent, is going to come back, and the Fed's are going to hike the rates even more. And the bond markets, where they just don't believe inflation is going to be as strong as the Feds think, are jacking up the shorter end of the duration or the yield curve and keeping the back end of the curve relatively flat, which is what's driving our yield curve to the 0 point or lower. So these are the things that are on my mind, guys, as I watch these markets. And there are pockets where we've been able for our members to make some good money on some long stocks, but we're also long volatility right now. And for those of you that understand options, you may want to be looking at, rather than credit spreads, because even if you go north of the market and put on a credit spread in hopes that it rolls over, if all it takes is one Trump tweet and you're screwed, because the markets will just screw right back up again and run over your credit spread. Same thing with, I don't think the markets will go this low, and then it takes one or two Trump tweets and now your credit spread is run over to the downside also. So you want to try and be long gamma. You want to try and be short delta, or at worst case, hedged in the volatility markets, or maybe picking up some utilities and XLP. For our members, I'll go into more detail on that this Sunday evening, going into this holiday shortened week. But I've already said that vol is up this week 16.8%. It closed the week at 1609. As you can see right here, You can see vol, since June, just like utilities, vol has been moving up very steadily, but very quietly, very stealthy. And now the question is, it's gonna hover around this yellow zone here, which kind of carries us from 15 up to the low 20s, right? It's what I call, you'll notice I've zoned out the colors of the price level of volatility, going all the way up to a black swan up here over 50. And you can see here that we're in the yellow, which is a cautionary area for volatility right now. And we need to treat it as such, all right? And of course, if we look at the bond market has done just what I said it would do. Doesn't mean I've got a crystal ball, but it just by looking at all the charts and the relationships as I've been talking about here for the past month, we're seeing interest rates move a little bit higher. Interest rates moving a little bit lower, bonds moving a little bit higher for a safety fear gauge kind of trade. This has also been shown in the utility sector as well. If trade tariffs hit and July the 6th comes and we slap 50 billion in duties on Chinese goods, I promise you, you're going to get on Saturday or Sunday, there'll be a response from China. And then come Sunday night, the markets will be, the Dow will be down another 500 points on Monday. 500, probably 400 to 500 at a minimum, all right, if those tariffs do come true. So you need to be ready for that. In fact, for our members Sunday night, we'll go through some key things that we need to prep for. Now, if they don't do that and Trump does what I said he may do, and I think it's a 50-50 right now. It's a lost in space moment. I have no idea what he's going to do. It's a binary event. I'm treating it like a binary event. It either happens or it doesn't happen. And regardless of how strong and bullish your charts show you, if it happens, everybody's going to be punished. You'll see correlations go up dramatically should that occur. All right. So now if we look at currencies, the dollar was off a pretty good bit on Friday. Look at that. That helped the emerging markets a little bit. You can see this dollar coming down because if money rushes into the bond market, it's going to drive interest rates lower and you'll see some more profit taking in the US dollar. All right. But we've got a cross, unlike the death cross I showed you earlier in the Chinese markets. In the dollar, we've got a very strong bullish cross. So again, this serves as a support point for the US dollar around the 92.50 area for the dollar index. I don't think too much downside, but if it sells off a little bit more in a Machiavellian way, it'll be good for emerging markets. It'll be good for other countries. But that's kind of where we're sitting here. And if we look at the euro had a good strong day because it's kind of the mirror image opposite of the dollar. I'm still projecting the euro right now to go down to the 114 area, but probably over the summer months. I think there's a little bit more of an upside in it. But again, these trade tariffs are going to have a big play on this, so we're going to have to react accordingly. I can't tell you right now how it's going to play itself out. All right, gold. Gold is playing to our script, guys. Gold came down and it hit 1246. I said the nearest level would be around 1252. How did I get that number? Right in that area right there, but 1238 is the next stop off point. So I think any move up is going to be a dead cat bounce. There is no divergences, bullish divergences in gold, so I can see. And gold tends to trade very technical. You can see because it could not climb above the 2018 open price. Remember, the 2018 high price is 1369, and we closed Friday at 1254. So that's over, about 100 points or so, right? A little bit more. So that's kind of where we're sitting right here to the downside. Silver was also breaking out of the channel. If we look at silver futures as kind of a reference point, you can see we broke out of that triangle and we're going to come up and do a retest. And if we roll back over, we're going to come down to the 1563 area for silver. The gold being lower, silver being lower shows that unlike what you would expect for a fear gauge with all this turmoil going on, this is reacting due to the interest rates and no inflation. More so, interest rates and no inflation is what's driven gold lower and silver down too. Okay, silver is going to outperform gold, I think, to the upside on a percentage and return on capital basis, and I think it's going to be higher in 2 years. But near term, I think it's got still some more, maybe a little bit of a upside bounce and then roll back over again. Oil. Oil is really interesting. This is all about OPEC and what's been happening here. Look at this massive move in just 2 weeks. Oil moved from 63.55, right? I mean, we went from a high of 74.46 from the low of roughly about what was that low right there? About 63.59. So 63.59. That's 10.87 dollars per barrel. And if you divide that by the 74.46, we've moved in the past 2 weeks over 14.5% in oil. And that is not without a 12% drop earlier. These are huge moves. I do believe oil is going to come back and probably come back to the 72 area. Now, I just saw a tweet this weekend, in fact, this morning, where Trump said he just talked to King Solomon. I think that's the guy's name. And he agreed to output more oil to the tune of 2 million barrels. But then Iran immediately came out and said they can't do that. We've got an OPEC agreement. If they do that, that means they're out of OPEC. So I think Trump is always noted for hyperbole. So I don't think they're going to do 2 million barrels. They may do a couple 100,000. They may get Russia to do another couple 100,000 to a net of about 500,000. But remember, Trump can always go into the strategic reserve where we got, just slightly under 700 million barrels, and then just flood the market with about 30 million barrels, 50 million barrels of oil over the next 6 months to make up what Saudi Arabia doesn't. That's enough to move the markets down to, let's say, the low 70s over the next week or two. Right, so that's a nice move to the downside. So this extreme movement has been extremely difficult for oil traders, unless you're day trading it. Very, very difficult to do. Okay, very difficult. So that's where we're sitting right now, mostly a lost in space for the markets, where we've got all of these markets just collectively moving all over the place based on the Trump administration's on again, off again, lost in space tweets, misinformation out of the administration. Now, don't get me wrong. I like what he's doing financially to the markets, less regulation, tax cuts. I like those things. They're all bullish, but his execution is not that good. And that has caused the markets to react accordingly. And that's why we're facing all these. Maybe at the end of the day, if we go out another year, the markets will be higher, but I think we can get there with less of this sine wave move in the equity markets. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday night. For those of you that are non-members, I hope to see you in our group. We're doing really well. We should kick it for the last part of the year. We got a lot of interesting things I see coming up going into 2019. Have a great weekend, everybody. And folks, I'll see you this Sunday night in our weekly market watch. Take care, folks. Have a good one. Ciao.